Hey everybody, Smart Silver Stacker here. Welcome to another live stream. Let's talk about why the price of gold and the price of silver are dropping today. And I want to get into the dynamic that is driving that, because it's not a new one. It's the same old dynamic that we've been witnessing, in which higher than expected inflation reports drive the price of the metals down. But I want to talk about what's driving today's fall in the price of gold and silver specifically, and why that dynamic is almost certainly going to end at some point here. Now, I'm going to talk about why that is all but guaranteed. Got a number of updates for you today, which I think will lead you to the same conclusion possibly that I've come to. Now, let's just take a look at the price of silver today. You can see coming under some very significant pressure following the announcement of the January CPI numbers. Before trading, gold and silver were actually in the green. Now that number released at 8:30, hotter than expected, and you can see both gold and silver basically falling off of a cliff. As that happened, gold actually dropped down below $2,000, although it did pop back up. Since then, it's just over $2,000, and the inflation numbers from January coming out hotter than expected. Surprise, surprise. It's a 0.3 increase month over month. The year over year number came out to 3.1%. That was against expectations of a 0.2% month over month increase and a 2.9% year over year number. But that wasn't what we got. We got a higher than expected inflation number. And we're going to see more of this moving forward. Now, the idea here, why this is driving the price of gold and silver down, and really just assets across the board. I mean, it's not just gold and silver selling off today, is because now markets anticipate this is going to make it harder for the Fed to cut rates. Now, this is basically because all the fundamentals are out the window now. I mean, think about the fundamentals for gold and silver. There's been huge amounts of money created. The Fed balance sheet still over $7 trillion. Inflation is very high. You would think that gold and silver would be doing well. But right now, fundamentals don't matter. It's all just about easy money. One interesting point about the inflation numbers that we got today, one of the things driving prices higher was that shelter prices were up. So rent, one of the interesting things about the CPI is that the housing cost is actually one of the most manipulated numbers in there. For rents, they don't even take into account what real rents are. They go by this owner equivalent rent, which is a survey of a couple thousand households where they ask owners what the rent would be if they were to rent, something like that. I mean, it's a completely cooked number. It's designed to understate the real inflation, like much of the CPI formulation. But despite that fact, we are seeing shelter being one of the bigger components. Now, if they actually took into account what real rents are, I think this number would be even higher. But look at this chart here from CNBC of the month-over-month change in the consumer price index. Back in October, we were hearing all this talk about disinflation, about how inflation's coming down. Well, now you can see the trend is, since then, every month, the number has been rising, the month-over-month number. And I think this is going to continue to be a trend because, of course, the thing that really guarantees inflation is going to continue to expand is all of the new debt that's being created, the inevitability of that debt being monetized by the Federal Reserve. Now, let's take a look at some of the other points here. The expectation, 0.2%, 2.9% year over year. The core CPI was also up significantly. And, the interesting thing is if you annualize these numbers, if you annualize the increase in core CPI month over month, which was 0.4%, so even worse than the headline CPI, you get a number of like 4.8%. Thank you, Joshua Gaming, for the super chat. He says he's looking forward to Senate Bill 1314. I'm not sure what that one is. Let me know in the chat if you know what it is. So, look, I mean, the dynamic here is that markets now believe the Fed is going to delay their cuts. Everything is about easy money at this point. I mean, the markets are so addicted to easy money. The only thing that really drives price action is what the Fed is going to do next. And now, with a hotter than expected inflation print, it means that markets are discounting basically completely the possibility of a March rate cut. You can see now, according to the CME FedWatch tool, it's only an 8.5% chance of a rate cut then. Notably, in May, also, the number has now dipped below 50%. So markets now anticipating that we're going to have to wait until June before we get any kind of rate cuts from the Federal Reserve. Now, maybe, just maybe, the Federal Reserve can put this off until June. However, the thing here is that there's going to have to be rate cuts. It is inevitable, and we're going to talk about why. But I also want to talk about this dynamic in gold and silver because, why do people buy gold and silver? They buy it as a safe haven asset, right? As insurance against inflation, against currency collapse, especially when you're talking about the physical metal, the real metal you can hold in your hand. Now, nobody is looking at this current situation and thinking this is going to get out of hand. Everybody thinks everything is under control. There's no real problems. But the reality is the situation is much worse than what we are being told. This one from Bloomberg, just from yesterday, commercial property loans coming due in U.S. jumped to $929 billion. This is from the Mortgage Bankers Association. So previously, they had been estimating that $659 billion of CRE loans would be coming due. But now they've had to increase that number to 40%. This is attributed to loan extensions and other delays. But this is one of those reasons that the Federal Reserve 100% is going to have to slash rates to avoid a major financial crisis. Because the problem is, a lot of these loans coming due, the properties that are backing them up are not worth nearly what it says they are worth on paper. They're not going to be able to refinance these loans at higher interest rates. And if the lender is forced to take the collateral, the property, onto their books, well, the problem is that it's not worth nearly what they've loaned out against these properties. So they're going to take massive losses. It's just another example of how the banking system, especially the regional banking system in the U.S., absolutely is going to need bailouts in the form of massive interest rate cuts, massive, lowering of rates. How's the Fed going to do that? Well, they're going to have to get into the market and they're going to have to buy up the debt. They're going to have to go back to QE. But listen, you talk to anybody on the street right now, and you talk to them about a banking system crisis, commercial real estate, the majority of people are not going to take you seriously because they are buying into what they're being told by the administration, by the mainstream media, by individuals like Janet Yellen, Jerome Powell, the central bankers who tell you everything is fine, everything is robust, everything is well capitalized. But that's not the case. And that's part of this dynamic in the physical gold and silver market as well, because we already know that when the emperor has no clothes moment plays itself out, when the veils are lifted from people's eyes, they're going to rush into physical precious metals. That's what happened last March when the regional banking system began to collapse. Remember, the premiums shot up on physical metal, and you can just basically interpret that as the price of physical gold and silver increase, because premiums are just, based on the paper markets, which are all, ostensibly manipulated. And, a lot of people are going to look at the price of silver falling today, and they're going to say, this is all manipulation. That's what's going on. But it's not really hard manipulation in the way you might think. It's not because the banks are out there instituting a bunch of new shorts. Now, are some of the banks, short the market when they don't have underlying metal? Yeah, probably. But the type of manipulation that is going on is more the soft manipulation. It's the controlling of perceptions, the manipulation of perceptions. And that's why, when you talk to the average person on the street right now, they're not going to understand the problem with $929 billion of commercial property loans coming due in the next year. They don't know that that's why the Fed is going to have to print enormous sums of money. They don't understand that about $4.7 trillion of debt is backed by U.S. commercial real estate. According to this report from Bloomberg, that is ratcheting up concern among regulators and investors as building values slide. But look, if you're placing your faith in the regulators, think about The fact that New York Community Bancorp, that's the regional bank which saw a massive sell-off last week when they announced losses from their commercial real estate portfolio, regulators thought that their balance sheet was sound enough for them to take on all of the assets from Signature Bank, one of the banks that failed last year, and yet that obviously not the case, right? So regulators can't fix this. Regulators can't fix an economy which is basically built on an enormous bubble of debt that has been inflated by the Federal Reserve. And the Federal Reserve, if you think they're going to let that economy pop, let that debt bubble pop in an election year, you've got another thing coming. I mean, it's not going to happen. According to the MSCI Real Assets Report, an estimated $85.8 billion of debt on commercial property was considered distressed at the end of 2023. But there's an additional $234.6 billion of potential distress. Yeah, let's talk about trillions in distressed debt. We already saw what happened with NYCB, New York Community Bancorp, when they announced that they were experiencing losses, write-offs. Offices in the United States, people aren't going back to work from remote working. Maybe some people are, but occupancies are dropping. There are no buyers because the Fed has raised rates. Buyers cannot afford to finance these properties at these valuations with rates where they are. The only way the Federal Reserve can reinflate the property bubble is by slashing rates, and that's exactly what they are going to do. But again, this is a perception problem. If you talk to the average person about this, most people are completely unaware of this. When that dynamic changes, that's when you're going to see a lot of people rush into gold and silver. If you want to buy the dip today, by the way, my channel sponsor is SD Bullion & Where I buy my gold and silver. They have a great deal. I just want to make you aware of this. They have 10-ounce silver bars right now on sale, any quantity, 89 cents over spot. Now, two things I want to say about this. One, this looks like a pretty solid deal. I'm not telling anybody what to do. It's not financial advice, but 89 cents over spot for 10-ounce bar, pretty solid deal, if you ask me, in my opinion. But also, this shows that right now there's not a lot of demand for physical metal. And I just want to say, now is the time to buy. I know that can be hard to do psychologically when prices are down. That can be tough, but I think that, you want to buy low and sell high, just my take on it. So you can check that out if you want. I don't think it's on their deals tab, so you'll have to kind of hunt for it on their menu. But if you go to the 10-ounce silver bars, 89 cents over spot, any quantity. Thank you, Joshua, for the super chat again. He says BTFP funding program ends in less than a month. Yeah, well, that's what we've been told, but I have a hard time believing that the Fed is going to phase that out completely. I would not be surprised if when we see a real crisis manifest itself in the banking system, if the Fed doesn't just create a commercial property funding program or something like that to take some of this debt off of these banks' balance sheets, just maybe QE by another name. They probably won't call it QE, but they're going to be expanding their balance sheet and probably expanding it massively. And again, when this becomes apparent, I think that's when investors are going to switch. Now, it's not just gold and silver that are going to be headed higher, though. I mean, assets across the board are going to be heading up. Look at Bitcoin. Bitcoin was up over 50,000. I mean, I'm kind of coming around on these digital assets. I've always been pretty skeptical of them. I think it is going to be interesting to see when that event takes place, when confidence is lost in the banking system. And we kind of know that isn't happening yet because there hasn't been any kind of demand for the real safe haven assets, gold and silver. It's going to be very interesting to see if Bitcoin functions as one. That's what we've been told. I mean, we're going to have to wait and see, but it is back up to almost 50,000. So, alternatives to fiat, I think, are going to be very popular. But even stocks, paper assets, are sitting near all-time highs. This is the 5-year chart of the S&P. Stocks are selling off today, but still, I mean, they're near all-time record highs. I expect these markets to continue moving higher, and the reason is because the easy money is coming back. Now, let's say the Fed were to, do something unexpected here and talk about, not cutting rates and really trying to fight inflation. You could see these markets drop precipitously because they've already priced in more easy money. But I don't think that's going to happen. I mean, that's just my take on it. I think that during an election year, there's very little chance that the Federal Reserve, which, claims to be a non-political entity, but I think that that's probably all just a bunch of BS. Basically, they're appointed by politicians. They're part of the system. They want that cushy job. Like Janet Yellen, Secretary of Treasury, former chair of Federal Reserve. I don't think they're going to let that happen. So these markets are probably going to continue moving higher. However, I do think that once the true nature of this inflation problem becomes apparent to investors, and as the public kind of becomes aware of how shaky things really are, and eventually it's going to become impossible to ignore how bad things are, no matter how the talking heads, talk up the stability of the system. I think that we could see gold and silver outpace paper assets, but all this stuff is heading higher. And you want to get an idea of what happens to paper assets as a currency is debased. Just look at the Venezuelan stock market. This is a chart. This one's from Vice, but you can find a number of these charts in Venezuela as their currency hyperinflated and completely was debased. Their stock market was doing great. Now, I don't know that it really kept pace with inflation, but at least in nominal terms, the Venezuelan stock market absolutely took off during their hyperinflation. And I think as you see the dollar debased, you're going to see the same thing in paper assets. Might be nice to have some foreign paper assets, the ones that earn their incomes, pay dividends in non-dollar currencies, but it's a race to the bottom for fiat currencies, and I think paper assets in general are going to take off. But again, gold and silver, once the real nature of this beast becomes manifest, they're going to move even faster. And if you want to guarantee that inflation is headed much higher, that more debt monetization is on its way, the Senate just passed another $95.3 billion aid package for Ukraine and Israel, and that's got to pass the House, but guaranteed more of this funding for foreign conflicts is on its way. More war is nearly inevitable. This is the name of the game. Central banks basically have one tool. It's printing money, and they're pretty good at it. They always find some excuse to. So it's going to be a crisis here in the U.S. It's going to be a major conflict. The debt and the death is going to continue to grow, unfortunately, but that is something you can essentially bank on. Although, this is an interesting one. I just kind of wanted to comment on. In Ukraine, this is from Zero Hedge, so you got to kind of take it with a grain of salt, but Ukraine anti-conscription protests emerge as Zelensky hunts for manpower. To me, this is a sign that very soon, I don't think the West is going to drop this conflict, and this means probably NATO troops are going to be moving into Ukraine. Now, you might think this is kind of far afield from the silver price and from the financial system, but this is a big deal for the financial system because it's a sign of escalations coming. They're running out of manpower. A lot of Ukrainians have, probably needlessly been killed here. It's a very tragic thing. But they're running out of people. They're running into huge political problems with mobilizing more manpower. So, we're probably going to see NATO troops moved in maybe to the western part of Ukraine. I think that is something that is coming perhaps this year. Then, who knows? They might be targeted. You can see it's a recipe for escalation. Speaking of escalation, one of the assets that's actually still in the green today, crude oil, despite the fact that everything is selling off, it doesn't seem like markets' trepidations about a lack of rate cuts is going to put too much pressure on crude oil. And that, again, is because of all of the massive geopolitical escalations around the world. This also is likely to be a cause for much higher inflation moving forward. I think this price could absolutely skyrocket at, any event that takes place in the Middle East. Quick recap there and an update. You got the Middle East crisis growing as Israel now looking to invade Rafah, this border city in the Gaza Strip. Now, this has caused a lot of consternation in the Middle East. You had Egypt, this is from Stratfor, how Egypt has threatened to void troop limitations of Camp David Accords. Those are peace deals that were signed back in 1978, and they've kind of been the foundation for what stability there's been in the Middle East, a peace deal between Israel and Egypt. Now, they have kind of gone back on that, backpedaled a little bit on that, saying that peace deal will continue as long as Israel limits civilian casualties in this strike. But the mere fact that Egypt has threatened to cancel the Camp David Accords, I think, is indicative of how bad this Middle East crisis is becoming. No sign of de-escalation whatsoever. The U.S. launching hundreds of airstrikes against supposedly Iranian-backed militias. You've got Israel invading Rafah. There are likely to be a number of civilian casualties here. That puts the whole peace deal between Israel and Egypt at stake, and that is why this number, the U.S. national debt, is going to continue to absolutely explode as a result of all of these ongoing conflicts around the world. And, it's no surprise that we are headed to conflict here as this financial crisis really reaches a peak. If you think that the conflict, the airstrikes in the Middle East are about Gaza, it is so much bigger than that. I think that much of the military conflict unfolding in the Middle East right now is all about the BRICS nations and sending a message to them and defending the petrodollar, defending the dollar's status as the world reserve currency. And if that goes, well, that's going to be a huge rude awakening for everybody in the West. You think, 0.3% month-over-month inflation number is bad. That ain't nothing. You haven't seen anything yet compared to what is coming if the U.S. dollar status as the world reserve currency comes into question. And look, that's not the sort of thing that's going to happen overnight. The global financial system doesn't just shift, but, there's a clear trend in that direction. You've got these BRICS nations are all trading now in non-dollar currencies. They're looking to move away from that. And what are we doing? We are launching airstrikes on Iranian-backed military units in the Middle East. Iran, now a BRICS member, one of the leading figures calling for global de-dollarization. And, this is a warning that we got from Jamie Dimon about that number, that U.S. debt number, which is just continuing to explode. It says mounting U.S. debt will eventually spark a rebellion in global markets. Says that's because $7.6 trillion of U.S. government debt is held by foreign entities in countries like Japan and China, two of the biggest holders. And they don't want to hold devalued currency. We just keep borrowing more. Janet Yellen said, if we don't raise the debt ceiling, we're going to default potentially. So, what does that tell to foreign holders of U.S. debt? Like, hey, if we don't borrow more, we're never going to pay you back. It's a Ponzi scheme, basically. That's the definition of a Ponzi scheme. It's like you need to keep borrowing to pay the existing borrowers. Now, we do have a printing press, it's true, so modern monetary theorists will argue, the debt can get as big as you want. And, if that was true, if it was true that the debt could go to any number, you can get $2 quadrillion of debt, because that's basically what they're saying. U.S. has a printing press, print as much money as you want. Why don't they just print $2 quadrillion, and spend it? Bring everybody up out of poverty, inject it into the economy, make everybody rich, send everybody stimulus, just pay off the debt, what is it they say, mint $1 trillion coin and stick that in the treasury and just use that to pay off the debt. All of these things are complete lunacy. There's no way you can do it. Eventually, the dollar will get dumped if we continue. Now, Jamie Dimon says it's a cliff. We see the cliff. It's about 10 years out. We're going 60 miles per hour. I think that is perhaps a very rose-colored glass is assessment of the situation. A very rosy picture he paints here. Says the U.S. debt to GDP ratio looks like a hockey stick chart, so an exponential move, basically, or one that starts relatively sideways before eventually spiking. He expects the measure to hit 130% by 2035. I think that is, again, very optimistic. That hockey stick doesn't start yet, he said. We kind of got time, but when it starts, markets around the world, there will be a rebellion. And this could happen very quickly. With the level of spending which we are about to undertake related to global conflict, this number is going to massively increase. And Jamie Dimon's right. There will be a rebellion in markets. There will be a massive financial crisis. When confidence in the dollar is lost, that's going to be a huge problem. And that is the inevitable outcome of printing as many dollars as you want. That doesn't mean they're not going to try to defend the dollar's role, but eventually it will become impossible. And again, when that happens, the whole dynamic in gold and silver is going to change. Now, look, when the Fed starts printing, is gold and silver going to take off? I don't think it'll surge. I mean, it might move up like other assets when the rate cuts actually come. But if it's a crisis that triggers the rate cuts, and that, often has been the case in the past, it's like the Fed will start really trying to come to the rescue once things break and they have the cover to do so. Then, yeah, all bets are off for physical metal. And until that time, I mean, the prices may languish relative to paper assets more compared to the more speculative assets like Bitcoin. But when that happens, again, we got a preview of this last year when the banks started to fail. Everybody who tried to pour into gold and silver. And the thing is, the physical gold and silver markets, especially silver, they're not very big. There's not that much retail metal out there available for people. Now, there are, maybe even billions of ounces in the hands of stackers, but I mean, what price is the price of silver going to have to rise to get those stackers to sell? I mean, if they're not selling out of disgust, I mean, the weak hands, I think, have been shaken out at this point, then they're not going to sell unless the price goes massively higher. And that is, what we stack for. Now, will there be opportunities in other assets, in paper assets, in Bitcoin? Yeah, there likely will be. But when the music stops and when the true nature of the financial system becomes apparent, and not everybody isn't out there speculating, trying to get rich, when everybody's just trying to protect their wealth from being completely eviscerated by printing, I think you're going to see a very different dynamic in the gold and silver market. And it's not going to be when inflation rises that you see the price of gold and silver come down. No, you're going to see inflation soaring, but you're going to see the price of gold and silver increasing even faster. But that's just my take on it. Let me know what you think in the comments down below. And thanks for watching, everybody. Stay safe and happy stacking, and I will catch you next time. Smart Silver Stacker